So I'll just go through F and then we'll take a break. Is that okay, Gary? Yeah. Okay. So looking at F, in the foreign income revenue, you want to know, have you received dividends from the UK, Great Britain and Northern Ireland? If you do, then you have to declare them. Have you got a foreign pension? And if you have, then that has to be declared. Have you received interest from outside Ireland? If you have, the interest, if it's coming from an EU country, is taxed at 33%. The reason being that it has to be at the same as the DIRT rate in Ireland. And then if it's outside the EU, 41% on a self-assessment basis. Foreign employment, you can potentially get transborder relief. Now, transborder relief, the way it works is if you have, say, the usual case that where this might work would be somebody working in the Republic of Ireland, or sorry, working in the north of Ireland, and then, living in the Republic. So if you were, say, living in Donegal and working across the border in, the north of Ireland, then you might be on UK PAYE, and at the same time, then you have to declare your UK income in Ireland, and the transborder relief essentially reduces your Irish tax liability to the equivalent of the UK PAYE that you've already paid. That's how it works in simple terms. And it's not just with people working across in the north of Ireland. You might have somebody who's commuting from, say, Dublin to work in London every week and then coming back at the weekends. And then that person would also be entitled to transborder relief. It could even be in France or Germany. Important point is that the employee needs to come back at least once a week, because if they don't, then you may not be entitled to transborder relief. And Revenue are looking in detail at transborder relief claims and disallowing them if they don't meet all the conditions. Dividends from the US and Canada, foreign trade or profession. This might apply, for example, if you, say, for example, you happen to own a pub in the Canary Islands. That would be a foreign trade. And you might own it and have somebody managing it, but the profits from that pub are declared in the Irish tax return as income from a foreign trade. Same with foreign rental income. You own an apartment in Paris and let it out. You're liable to Irish tax on the French rental income. You can't say to the Irish Revenue, it's all the French tax is paid on it. I don't have to pay any tax in Ireland. You do. You pay the Irish tax and you get a credit for the French tax against the Irish tax. Any other foreign income also has to be declared. And then we get into these various types of exit taxes. There's a 41% exit tax, which is an income tax on disposal of foreign life policies. Similarly, on gains made with offshore funds within the EU and tax treaty countries. And then other offshore products which are outside the EU and treaty countries, there's a similar 41% liability on a self-assessment basis. The one to watch there is the 8-yearly charge, because if you have been invested in an offshore product outside the EU, EEA or a treaty country, and 8 years have passed by since the investment happened and the fund is appreciated, you could be hit with an 8-yearly charge and not even know about it, the fact that you have to declare it. So if you have a client who has a fund like that, you need to be asking or seeing the documents for the fund to see, has the 8-year been reached, and is there a self-assessment or requirement to self-assess the gain. All of these gains on these offshore funds, it's not possible to offset normal capital losses against these because they're income taxable. And similarly, if you've made a loss on an offshore fund or an offshore product, you can't claim that loss against the normal capital gains, which is not great.